In today's video, I'm going to show you 5 different ways to pay 0 federal taxes in retirement. You've probably seen 1 or 2 of them, but 3 of them almost no one is talking about. But here's the thing. If you get just one detail wrong, you could accidentally trigger a tax bill that's bigger than if you'd never tried this at all. So stay until the end because I'm going to show you the 3 hidden traps that turn a 0 tax strategy into a potential financial disaster. My name is Amzalag. I'm a certified financial planner and the owner of Peak Financial Planning. Let's just dive right in. Before we get into the techniques that almost no one is using, we need to start with the foundation because if you don't understand this, the rest of the material won't make sense. The standard deduction, I'm showing this on the screen now, for a married couple in 2025 is $31,500. That deduction means that you don't pay tax on income up to that amount. Now, if you're 65 or older, you also get an additional deduction of $2,000 per partner, and the One Big Beautiful Bill Act added a new senior bonus deduction of up to $6,000 per person for those 65 and older. Add all those things together, and now a married couple age 65 or older can shield up to $47,500 of income from federal taxes. That's nearly $48,000 that the IRS can't touch before you even start optimizing anything else. Now, here's where things get interesting. Long-term capital gains, those are the gains or profit from selling investments you've held for longer than a year, are taxed at 0% up to a certain threshold. For 2025, that threshold is $96,700 for married couples filing jointly. So if you structure things correctly, you can have $47,500 shielded by the standard deduction, as you can see here, and senior bonuses, and then another $96,700 in long-term capital gains taxed at 0%. That's $144,200 of income with 0 federal tax. And here's something that's going to blow your mind. By the end of this video, I'm going to show you how to access up to $237,500 in spending money, not $144,200, while still paying 0 in federal income tax. So stick around because that's coming at the end after I show you the 5 methods and the 3 traps that you need to avoid. But first, let's get straight into the techniques. Let's start with the technique that most people have heard about, and this is what's called tax gain harvesting. It's also called capital gains harvesting. Here's how this works. Say you bought an index fund years ago for $100,000 and today it's worth $200,000. You've got a $100,000 unrealized gain sitting in that position. You can see that here. Now, you can't just sell the entire $200,000 position because that would push you above the capital gains 0% threshold. So instead, you just sell enough to realize exactly up to that threshold. In this case, with a 50% cost basis, that means selling about $193,400 worth of the fund. You realize $96,700 in gains. You can see that there. The IRS gets nothing, and now you have 2 choices. The first is that you can withdraw some or all of that $193,400 and use it as spending money. Remember, only $96,700 of that was a gain or profit. The other $96,700 was your original invested monies coming back to you. The second choice is if you don't need to spend that money, either some or all of it, you can reinvest a portion or all of it. But here's the key. You want to reinvest it into a different investment so that you avoid what's called wash sale concerns. So maybe you sell an S&P 500 index fund and you buy a total market fund or a different index entirely. Now, wash sale rules are one of those booby traps that I mentioned earlier that could turn this 0 tax strategy into a tax mess. So remember, towards the back half of this video, I'm going to go into more detail about a few of those booby traps, okay? Now, say your cost basis has been reset based on the actions we just talked about. So if that investment in the example grows to $250,000, you'd owe tax on $153,300 if you hadn't done the tax loss or the tax gain selling. With the reset that you would do under that prior example, you might only owe tax on $56,000 roughly. So you just made $96,700 of future gains disappear from a tax perspective completely legally. Now, this is the baseline when it comes to tax-free withdrawals and planning. And most people stop here. But let me show you 4 techniques that make this concept and engineer it into something much more powerful. All right, so here's where we get creative. Method number 2 here uses the standard deduction and the capital gains cliff and what's called tax lot selling, L-O-T, lot selling. So let's say you need to pull $120,000 from your taxable brokerage account. Most people would just sell shares and then take whatever gains come along with it. But if you're strategic, you can use tax lot selling to control exactly which shares you sell. and therefore exactly how much gain you realize. Here's how this works. You bought shares of the same fund, let's say at different times and at different prices. Some have big gains, some have small gains, and some might even have losses. By selecting specific lots of shares to sell, we can sell the shares with the highest gains so that we end up procuring the money we need, but also keeping shares with a friendlier tax basis later on. So strategically done, you could generate the $120,000 you need, keep your total realized gain under that 0% capital gains threshold, and leave yourself with tax-friendlier shares for the future. And the net result is you get your money, you stay under that tax bracket, and the IRS gets nothing. So tax lot selling does require you to have what's called specific identification accounting set up with your brokerage. But once you do that, it's like having a dial that you can tune in order to control your tax bill. The third method we're going to talk about is combining the standard deduction with capital gains cliff and what's called tax loss selling. Tax loss is different from tax lot, just to be clear. Now, let's take this a step further and look at this third method. Let's say the market has a bad year and some of your holdings are down. Tax lot selling positions at a loss, also known as tax loss harvesting, can also provide some unique opportunities to clear more spending money without a tax effect. You can sell those positions at a loss and use that loss to offset other gains. So I'm going to show this on the screen here. For example, say you have $200,000 of NVIDIA stock with a $5,000 cost basis, but you also own $100,000 of United Healthcare with an $100,000 unrealized loss. You could sell $102,500 of NVIDIA, which would realize $100,000 in gains. And then you could sell that $100,000 of United Healthcare to realize $100,000 in losses. They would offset each other, causing $0 of income. And you'd potentially have $202,500 of money that you could allocate for spending, reinvestment, whatever you choose. In this scenario, because the loss and the gain offset each other, you would be able to incur an additional $96,700 of capital gains and still stay within the $0 tax bracket. So now you're pulling income, you're realizing gains up to that 0% threshold, and you're using losses to neutralize anything that would push you over that bracket. You stay at zero tax while repositioning your portfolio or producing more spending money. The key here is to have a diversified taxable account with positions at different gain and loss levels so that you have the raw material to work with. Now, these three techniques are powerful and work. And if you implement them correctly, you're going to be completely tax-free federally while accessing significant cash flow. At this point, most retirees think they've got it figured out. They're harvesting gains, using tax loss harvesting, overall feeling pretty sharp. And that's exactly when they walk into traps. There are 3 hidden traps that can turn a zero tax strategy into a financial disaster. These traps catch retirees out all the time because they're focused on federal taxes and they miss other items. So let me show you what those traps are. And then I'm going to show you 2 advanced strategies that actually help you avoid them. Let's start with the traps first. The first trap is Medicare IRMA surcharges. And this is the trap that blindsides many retirees. Say you successfully avoid all federal taxes. Awesome. But if your modified adjusted gross income, your MAGI, spikes above a certain threshold, even from capital gains, you can trigger massive increases in your Medicare Part B and Part D premiums, and those occur 2 years later. Here's how this works. Medicare looks at your tax return from 2 years ago to determine what you pay for premiums today. If your MAGI crosses what's called IRMA threshold, which is the penalty threshold, your premiums go up. And they don't go up a little, they can go up double, triple, or more depending on which bracket you hit. Push your MAGI too high and your Part D premium could go from $185, which is the standard base, as high as $628 a month. Here's the kicker. Capital gains count towards your MAGI. So even though you're tax-free at the federal level, you've stayed under that 0% bracket, you could be harvesting $96,700 in gains or profits. That goes into your income and crosses potentially an IRMA threshold or pushes your MAGI above an IRMA threshold. And then you get hit with an extra $2,000 or $5,000 a year in Medicare premiums. You think you save money and you do on federal taxes, but you might just end up paying it to Medicare instead unless you're careful. And you won't even see it coming until 2 years later. The second trap retirees run into is the ACA subsidy cliff for early retirees. If you're retired but not yet 65, you might be relying on Affordable Care Act subsidies to pay for health insurance. And if you are, you need to be careful with capital gains. ACA subsidies are based on your income relative to the federal poverty level. If your income's too high, you lose the subsidy and it could be partial or complete. Just like IRMA, capital gains count towards that income calculation. So say you're 62, you're retired, and you're getting a $15,000 a year annual subsidy on your health insurance. You decide to harvest some capital gains because why not? They're taxed at 0%, right? But if those gains push your income above the subsidy cliff, you could lose that entire $15,000 subsidy. Yes, you avoided federal taxes, but you just cost yourself $15K in healthcare costs. And unlike IRMA, which kind of has these phases and brackets, some ACA subsidy cliffs are sharp. You cross the line by even $1 and you lose thousands in subsidies. Okay, the third trap to pay attention to are state taxes. Here's what catches people. You can be completely federally tax-free, but still get hammered by your state. Right? Not all states follow the same federal treatment of capital gains income. Some states don't have a 0% bracket at all. They just tax capital gains as ordinary income. So you could harvest that $96,700 in gains. You pay nothing federally, and you might still owe $5,000 or $10,000 to your state. In my home state of California, for example, they tax capital gains as ordinary income with rates up to as high as 13.3%. In New York, you could get hit with an 11% or up to 11%. And even some states with flat taxes like Illinois or Pennsylvania, they don't give you a break on capital gains. Here's the other piece. The standard deduction amount varies by state. Some states have their own standard deduction that's lower than the federal one. Some states don't have one at all. So if you're doing this planning, you can't just look at the federal picture. You also have to run the numbers for your state. Otherwise, you're going to end up thinking you're paying zero and then get a tax bill you didn't expect. And that's frustrating because these three traps are exactly why most people think they can only access up to, let's say, $150K in income. Now, most financial advisors would stop right here and just say, be careful, but stick with me because I'm going to show you two techniques that could, like I said, let you access $237,500 while minimizing or eliminating all three of these traps. So let's go there. One method of working around these three traps is to combine the standard deduction, the 0% capital gains bracket, and tax loss selling, and using cash. And here's where we start layering in multiple tools to give you maximum control. You're still using the standard deduction and harvesting capital gains at 0%, but now you're going to add tax loss harvesting to offset gains that might push you over income thresholds. Here's the power of this combination. Cash reserves mean you never have to realize gains you don't want to. So in a year where you're worried about your, let's say, your MAGI creeping too high, maybe you're close to an IRMA penalty threshold, you can reverse engineer your income sources and use cash to fill in the difference. When some positions in your portfolio have a down year, you can also harvest losses, and you can use those losses in real time to offset gains, which will not contribute to your MAGI. Or you can let those losses carry forward to future years, giving you more room to harvest gains later without pushing you over the 0% capital gains threshold. Then, in good market years, when you need to refill your cash reserves, you harvest gains up to that 0% limit. You use any carried forward losses to offset additional gains if needed, and you replenish your cash bucket. And here's the most sophisticated version. Say you didn't have access to a large cash reserve. Well, in this final scenario, you would take everything that I just showed or discussed in that last scenario, method number 4, and you'd add in strategic Roth withdrawals. Now, this is the ultimate control mechanism for managing tax traps because Roth withdrawals don't count as income at all. They don't show up in your AGI or your MAGI. Remember those three tax traps earlier? Well, Roth withdrawals are invisible to all of them. No state tax, no IRMA spike, no ACA subsidy loss. Let's see how this works in practice. One thing to note here is this Roth withdrawal strategy would make sense if you did not, let's say, have a large cash reserve and you did not have cash to be able to use instead of this. You would prefer to use cash as opposed to Roth funds if you had the access to it. But for this example, we're going to assume this person doesn't have cash to do this. So let's say you need $150,000 to live on. You harvest $70,000 in capital gains at 0%. You take $47,500 from your traditional IRA to fill up the standard deduction, and then you tax loss harvest $20,000 in losses that you can use to offset future gains. That gives you $137,500 in proceeds, but your taxable gain is only $50,000 because the losses offset the rest of the gains. So still tax-free, but you still need another $12,500 to hit your $150,000 spending target. So if you harvest more capital gains, you'd maybe push your MAGI higher, maybe over an IRMA penalty bracket. So instead, you pull that $12,500 remaining balance from your Roth account. So your total cash in hand ends up being $150,000. Your federal tax ends up being $0, and your MAGI is only $97,500. The Roth withdrawal is invisible to the IRS, to Medicare, to your state, and to ACA. And so using this example, you've got 5 different tools that you can blend year by year. The standard deduction, the 0% capital gains bracket, tax loss harvesting for flexibility, cash for timing or control, and Roth withdrawals that don't impact your MAGI. So now that you understand the 5 techniques and how to avoid the 3 traps, let me show you the concept that pulls all of this together. And it's the reason that I said the video says $0 in tax on $237,500 of income. So most people completely misunderstand this part. Income does not equal spending money. Here's what I mean. Let me walk you through how you could pull $237,500 in spending money while staying completely tax-free. The first step would be to fill the standard deduction with your pre-tax withdrawal. Withdraw $47,500 from your traditional IRA or 401k, and that's taxed at 0%. The second step would be to harvest capital gains to the top of the 0% threshold. So let's say we sell $135,000 worth of investments from your taxable brokerage account. Your cost basis on those investments is $38,300, which means you're realizing exactly $96,700 in long-term gains, taxed at 0%. So you get $135,000 in cash. Only $96,700 of that counts as income. The other remaining amount is your original investment principal coming back to you. Step 3 would be to tax loss harvest to create additional cash without additional income. So you have some positions that are down, so you sell $30,000 worth of losses. And in this case, it generates $30,000 in cash, but because it's a loss, you don't add it to your taxable income. The fourth step here would be to layer in Roth withdrawals. So say you pull $25,000 from your Roth IRA to reach that $237,500 spending goal. So you end up with $237,500. You pay 0 in taxes. $47,500 comes from pre-tax money. $135,000, really $165,000 comes from selling both appreciated but also investments at a loss from your brokerage account, and the balance comes from your Roth. And by using your Roth withdrawals for part of your cash needs, you keep your MAGI lower, and you end up with $237,500 of spending money, but an income that is far lower than that as far as your tax return is considered. And that's the difference between potentially staying under an IRMA threshold or maybe even keeping an ACA subsidy, and maybe even between paying moderate or high state taxes or getting crushed by them. The point here is that the $96,700 capital gains limit and the $47,500 standard deduction limit are income limits. They don't limit how much you can actually access and spend. So these are the concepts that separate people who understand these strategies from people who truly master them. And that's why this video isn't clickbait, right? It is completely achievable to reverse engineer a spendable amount of money and still end up federally tax-free as long as you do this system correctly. And so here's what I want you to take away from this video. Being federally tax-free in retirement is possible. I've shown you 5 ways to do it. 1 is pretty straightforward. 4 are going to require a little bit more engineering. And I know this sounds complex, and it is, but the good news is once you have understood these 5 levers exist, you don't really have to figure out the perfect combination yourself. You just need to know they're available and then work with someone who can run the calculations. And the difference between doing this successfully and accidentally blowing your tax situation up comes down to the details. You have to think beyond just federal income tax. You have to account for state taxes, for IRMA thresholds, and for ways to protect your ACA subsidies if you're using them. That's why at Peak Financial Planning, we built things around systems and not rules of thumb, because strategies like this work, but only when you account for all the variables, right? Your state, your healthcare situation, your Medicare status, your income sources, your spending needs, your account types, and your cost basis, right? You need a plan that looks at the whole picture and adjusts year by year as things change. And so if you want to see how we help clients at Peak Financial Planning engineer their retirement income to minimize taxes while avoiding hidden traps, click the first link in the description below this video. I've put together a free training that walks you through the exact process we use to build retirement plans that maximize your spending power while keeping you out of trouble. And if this video helped you see something that you hadn't considered before, do me a favor, hit that subscribe button so you don't miss future videos just like this. Thank you as always for your time and attention. See you in the next video.